Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. As investors stick handle through news of global tariff uncertainty, an increasing option for steadying the ship is alternatives. Fidelity's growing universe of alts offer ways to include private real estate investments, cryptocurrencies, and equity long-short strategy exposure to various portfolios. For instance, how can a longer-term view on private real estate add ballast to your clients' investments while short-term market volatility reigns in these markets? Here to take us into the world of alternatives and how they could play a vital role in your clients' portfolios is Fidelity Alternative Investment Strategist, Brendan Sims. Great to see you, Brendan. How are you?
Great to be here. I'm doing well, Pamela. Thanks for having me.
Delighted that you're here. Let's remind everyone about actually the universe that we were just talking about of alts, because it has been growing for some time. We're going to zero in a bit on real estate today, but just sort of take us through what now is on offer, actually.
Absolutely. So within the Canadian real estate, within the Canadian alternative universe, we have categories like real estate, private credit, private equity, infrastructure, commodities, for example. That's all on the private side. We can jump over to the liquid alternative side, which you and I have discussed extensively. Hedge fund-like solutions that are using long-short capabilities, other sort of synthetic exposures to underlying asset classes to gain exposure. So I think that both of those neighborhoods are growing. We're going to chat more on the private side about real estate today, but I think we're really excited about where that area is going and with response to the stick handle layer, where the puck is going, if you would. And I think that Fidelity is very much a leader covering forth in this space.
So I think some people joining you here today have heard about this new offering through the private real estate side of things. Why don't you just give us the 1, 2, 3s on how this came about? Because there must have been some catalyst for investors and for Fidelity to be looking at, bringing this to their clients.
I think this is a space, be it the private asset space, that we've wanted to enter for some time. And it begs the question of how do we best do that? Like, we have a strong suit in public equity and fixed income research. How do we bridge that expertise and the relationships and sort of the network that we have with our existing clientele to introduce private real estate? And I mean, the options are build it yourself or seek best in class. And we went with the latter of the two. We stood up a strategic agreement with Brookfield about 2 years ago this June, in which we stand to access the pedigree that they bring forth from the due diligence side of things, analyzing and assessing deals, as well as the operational capacity once assets are owned.
So they actually started to build a fund specifically for Fidelity to then...
More or less, yeah. And without getting too into things, we have an exclusive agreement with Brookfield in which they're gaining access to our distribution network, and we're gaining access to their sort of expertise in the space to purchase and or own and operate private Canadian real estate.
So when we say private Canadian real estate, are we talking about homes? We're talking about businesses, obviously. I think you have told us in the past that private companies, private real estate, it is actually the bulk of any marketplace in the US or in Canada. It's hard to get access to. This now gives you access to what exactly? What are we talking about?
We could call it, when you talk about the bulk, I refer to the public markets as maybe the tip of the iceberg, while the underlying private assets are likely the vast majority that are quote unquote like underwater.
Oh, that is a great analogy. Okay, or like sort of picture of it. So public markets being tip of the iceberg of what's on offer.
You got it. And I think that, like, for example, Brookfield manages over $1 trillion in private assets across various different asset classes. In
real estate being the biggest one, though.
Real estate's about $270 billion of their footprint. And they have, at a point in time, they had about $10 billion in the Canadian landscape, being more heavy in the US as well as Asian Pacific markets. They stood to kind of have an interest in growing out their footprint here in Canada, view markets as attractive for a number of different reasons. We've seen very enticing growth in rent, sort of 22 through 24. Obviously, the landscape where it sits today from a housing standpoint, whether we're talking about Canada, the US, Toronto specifically, there are very different pockets in very different segments of the market out there. But we're very interested, as they are, in accessing the space. I think that there's a bit of an imbalance. Okay. And like we see government, we don't want to talk politics here, but we see governments coming out and saying like we want to build 500,000 homes by said year. And I mean, some people think we can do it, some people think we can't. We're not going to get into that. But I do think that there is somewhat of a shortage of quality purpose-built units from an accommodation standpoint. Okay. But we can't just talk only about multifamily, right? Because this is going to be a fully diversified fund. We're going to be investing in industrial logistics type opportunities, the multifamily, which we've mentioned. We do have a category earmarked for special situations, which couple ideas that could fall under there, like old age purpose-built housing accommodation, whether that's intensive care and or not. We think about storage, like you can't drive for too long on a major highway without seeing storage facilities these days. We're interested in buying great assets at the end of the day.
So what is there right now beyond multifamily, industrial? You mentioned a couple of different areas there for special situations. Anything else?
Office and retail.
Okay.
So there is no requirement to move into that space. As far as our long-term allocation, we would have a segment earmarked to office and retail, but at this point in time, precarious environment, very much a wait and see. And we have the ability to be patient and wait for sort of the bid and ask to converge, if you would, or just very, very frankly, is to be on the sidelines and to not even have a bid necessarily in today's marketplace until we have more certainty on a go-forward basis. Like we have e-commerce greatly affecting sort of the retail channels. We have a great Canadian retailer who's sort of going through a process right now where millions of square footage may come online in a number of different malls across the country, depending on the outcome there.
Gee, I wonder which one that is.
Yeah, and I think that we need to be cognizant that e-commerce is greatly affecting this space, as well as sort of return to work, the balance of hybrid versus fully in person in sort of the office space. So we're wait and see to gain more clarity on what unfolds for that space.
So that's interesting. Can you give us some examples, maybe not the actual address, but describe to us a little bit about, what has been bought and put into it? Are there a couple examples that are good ones that you can share with us?
Yeah, absolutely.
Anecdotally, anyway?
So we began shopping like almost 2 years ago.
Okay.
2023, the environment was
2023, okay.
Yeah, 23, the environment was a bit dry. And again, that spread between bid and ask, it was far apart. 24, that began to converge. We saw deals getting done. We purchased our first asset in early 24, second, middle of the calendar year. So at present, there are 6 assets or 6 projects, if you would.
You could walk in the door.
Yeah, more or less. Within Fidelity Alternative Real Estate Fund, we have 3 multifamily projects and we have 3 industrial logistics. At a high level, the summary would be that we have just shy of 1 million square feet on industrial logistics. We have 2 facilities in Montreal and 1 here in Mississauga. I actually just drove by it this past weekend. It's I saw it for about 10 seconds while I was driving by, but it's cool to know that unit holders of the Fidelity Alternative Real Estate Trust, as well as our private investment pool owners, have tangible ownership of Canadian properties.
So you drove by it. It's in Mississauga. That's a GTA. Where else are some of these investments? Are you looking at farmland? Are you looking across the country? Yeah,
so we're not looking at farmland. We're centering our approach to major metropolitan areas. That would be your Vancouvers, Torontos, and Montreals of the world. And we actually own assets in all 3 of those locations right now. So I kind of kept on the industrials to begin with. The 2 in Montreal, one is located proximal to the airport, as well as the intermodal terminal. One is located in the Valleyfield, Quebec, which is close to the port. So I think you'll see commonalities across the industrial logistics properties that they are going to be very centrally or proximally located to key infrastructure. And I think that what that buys you is confidence that in years to come, you're attractively located for tenants of a variety of different characteristics.
So that's fascinating about the geographic sort of proximity and what you're looking for there. In terms of the buildings, the footprints themselves, are you looking for, I guess, how does Brookfield approach this? Are they looking for absolute top of the line, the brand name? Because presumably you can charge a lot of rent on that, or what's the strategy? Oh, sorry, I got you right in the middle of
no worries.
Glass of water there.
That's a great question. But what I would say is if we had to characterize the strategy, it's core plus. So in the world of real estate, if we span from core, kind of like your white glove or flagship asset, all the way down to distress or needing value to be added, opportunistic type investing, we'd be one hair just behind core. So we're looking at buildings where we can purchase and then stand to introduce maybe a CapEx program in the first little bit with respect to improving the asset. Forgive me.
Yep. And is it the type of improvement that would be like a massive gut job, for instance, if you think about it as a house, or are these just sort of incremental?
That would be on the opportunistic. These would be very incremental. Okay. So I'll use something we all know very well, like a condominium. Sure. Can you go in and revamp the lobby to a minor extent? Can you upgrade the fitness facilities, maybe make greater amenities for the social rooms that you can rent out and attract a better tenant in the process of doing so?
Interesting.
Maybe can you engage like a CapEx program as tenants turn over? Can you revamp maybe the washroom and or kitchen main living space to attract a higher paying tenant as you turn that unit over? So that would be a good example.
That's really interesting. On the retail side of things, we often hear that retail needs to be anchored by certain things that we all want. Often grocery is sort of associated with that, but there are other ways of looking at that anchor client tenant. How do you look at the retail side of things, or what's being discussed there?
With respect to the retail client from a multifamily standpoint, I think that if you look at the Canadian landscape, rents are up, housing's up, much of that cost from an ownership of private real estate is that as the price of real estate went up, rents went up proportionately. They don't always go up in lockstep with one another, but very much correlated, whether one's pulling the other up in a sense that higher rents command higher purchase prices on assets, or vice versa, that higher purchase prices means that if anyone's going to own this asset, they need to simply charge more. So I think that inflation is a real thing to the everyday consumer, and it has not excluded rent by any means.
Right, absolutely. Inflation is still circulating. Is there something that you want to speak to in terms of the diversification? I mean, that's what alts are being discussed as right now. There's lots of discussion that perhaps if you look at a 60-40, maybe more alts belong in the 40. That's one discussion to provide ballast, as I think we said at the beginning. What is the diversifying element to this particular trust? Then we might talk about who it's for, but
yes.
What's the diversification story here?
I think that that's really what you're going for, is that whether we have turmoil like we've seen on a year-to-date basis in 25, you're kind of filtering a lot of that out, and you're not fully seeing that. It's acting as more of that ballast or that rock or that stability in your portfolio.
Okay.
That has a lot to do with how the assets are marked. Because, and I use the example, like you could have a REIT, like a publicly traded REIT that owns a plaza on one side of the street, and you could have a private fund that owns the one on the other side. It doesn't mean that one plaza is less risky than the other. It just means that how they're marked and how they're moving around differ to a meaningful degree as far as how investors see them in their portfolios.
That's fascinating. Okay, so this is something that is for accredited investors. I'll ask you to sort of touch on that. So beyond that piece of it, and I think a lot of the people you're speaking to right now know what accredited means. Who is it for more broadly, though, once you get past that piece? Who is this for?
I can think of a number of different individuals who this would be best suited for. And like first comes to mind on the upper end of the segment of the marketplace, like say someone just sold a business, or say someone just divested from a portfolio of real estate assets. They built a bit of a mecca over the last, say, 40 years.
Like they owned a bunch of apartments.
They own a bunch of apartments,
Okay.
and then quite simply, they don't want to be a landlord and they don't want to go through the hassle anymore. But this is an asset class that has treated them quite well. Question is, as you liquidate this and you're looking for legacy planning in an environment where inflation is a real concern, there are sort of fiscal challenges going on. We saw the U.S. tax bill come forth.
Yes, there are.
So real assets are enticing in this environment. And I think real estate is very much at the forefront there. So for this individual, I think that Fidelity Alternative Real Estate Trust represents a great way on sort of a hands-off basis to own real estate and allow someone else to kind of operate and manage that for you.
So that's really interesting. And then perhaps from another perspective, those that are perhaps at a stage where they're renting, and who knows, maybe they'll always rent, but you want a little bit of exposure. There's an opportunity there, I guess, for exposure, right?
Yeah, and I think if we look at the Canadian marketplace, there was once a point in time where you go to work, you have a full-time job, you buy a home, you pay your home off. And I think that we need to recalibrate our expectation.
This is big, actually.
That's probably not as much of a thing as it was 40 years ago. And I think that socially, it needs to be very much accepted. And for one's mental accounting, it's very much okay to be a forever renter, to find great success in your career, to save, and to be very successful around that without having a principal residence. And that's totally fine.
And investing through something.
And that's just it. So if you're looking at your asset allocation as someone that doesn't have leverage to Canadian real estate, be it you don't own a principal residence, it begs the question of, I'm going to own great stocks, great companies in this space, that space. I'm going to have a multi-asset portfolio. Well, you might be a great candidate for a modest exposure to Canadian real estate to kind of just balance that and make sure you're well exposed.
So often if anyone is entering into a real estate story, whether it's a home, which it is for a lot of people watching, or a business, it's something that you expect to hold for a very long time. It's certainly not something that you trade in and out of. Maybe just amplify that, because I assume that's the same thing here.
Yeah, very much so. And when it comes to investing, stocks have daily or intraday liquidity, right? Mutual funds have a strike NAV every day at 4 o'clock. These buildings and or funds of this nature are typically things that you look 3, 5, 10 years out as far as an allocation of capital. So you need to assess your liquidity profile as an investor as well as a consumer to make sure that these are investment dollars and not consumer dollars 3, 4 years down the road to earmark to such a vehicle. And I think that with respect to that, one of the ways in which this gets done is through managed accounts. So if we look to those that are investing with discretionary portfolio managers, we talked about the need to be an accredited investor. Well, there is a way to invest in such a solution while maybe not meeting those definitions of an accredited investor. If someone is acting on your behalf as the designated PM,
the advisor, the dealer,
they are deemed the accredited investor, and they can make a lump sum or blanket purchase within a model portfolio on behalf of all unit holders that they manage money for. So I think that's a great way to kind of allow the everyday investor, and it's allowing individuals greater access to something that typically is reserved for chunkier trades.
Okay, interesting. So this, would we call it a sleeve? You'll tell me how the terminology works for this. But the managed portfolios, which sometimes we'll speak to David Wolf or Alon Khaled or David Talk, they will have, I think about a year ago, they had some of this exposure in the managed portfolios.
Was that the first, private investment pools.
Was that the first iteration of how Fidelity had that on offer?
That would be how we brought forward this real estate mandate, was that our asset allocation team, through the Canadian private investment pools, earmarked a cash allocation that Brookfield tapped into and began purchasing these properties with. We were excessively competitive, being an all-cash buyer in 2024 when the markets reopened and liquidity kind of re-engaged. But I think that for unit holders of our private investment pools, they have up to a 5% exposure to private Canadian real estate, to these 6 assets, to the property that's in Mississauga in their portfolio. And I think that's a great thing. When we talk about individuals accessing this through other conduits, I think that it speaks volumes. And I think that Fidelity will look to leverage the multi-asset portfolios abroad, whether that's our all-in-ones, managed portfolios, private investment pools, not specific to this vehicle, be it real estate, but just to allow investors to gain exposure to alternative asset classes.
Could it one day, in the way that cryptocurrency is in the all-in-ones, be in the all-in-ones one day?
I would say we always want to keep an open mind towards that. Okay. I think operationally as well as from regulation, we just want to be mindful to navigate accordingly and always go with a degree of conservatism and sort of keep an eye on sort of what we're capable of doing and what that would look like.
The regulatory environment opened up a couple of years ago to alts broadly, to long, short strategies, to shorting, and that was something that there are a number of products that were launched at Fidelity due to that regulatory shift. Just tell us a little bit about the regulatory shift, particularly for real estate, why that happened. I mean, what was the point of regulatory bodies thinking, okay, yeah, this is a good idea, let's open this up?
So I don't think that there's been any material shift per se to date, but I think there's underrollings with respect to the Canadian and the OSC or Ontario landscape, looking at, on average, how investors access long-term assets or access assets with lesser liquidity.
Okay.
I think that we'll use the word conduit to be the methodology through which investors deploy capital to throw towards these assets. And I think that we're in a repiping process, if you would, where using technology kind of through studies that are going on actually at present, we're reevaluating how to allow more investors to gain access to the other 2/3 of the iceberg, if you would.
Okay, really interesting. And some version of demand obviously must have been there. There must have been
investor demand. I think the demand is real, right? I mean, we're seeing massive growth. And again, we chatted earlier and we talked about sort of this history lesson where how do investors deploy capital to access great opportunities? And there was the onset of the innovation that was the mutual fund at one point in time.
So-called brought the fund structure to Main Street. I mean, are there analogies here to be drawn?
Absolutely. I think that the ETF, a number of decades later, was brought about, and we're seeing massive growth in that space right now. I think it's early days for how investors gain access to private assets. I think that technology is going to play a massive role. Like how the information tracking, the providing and or the transferring of funds and or the liquidity profile. There's a lot of mountains to be climbed to allow investors to have streamlined access to these asset classes. And I think it's early days. And I mean, I'm sure that when the ETF was launched, it didn't seem like we were going to have sort of the monumental growth that we've seen over the past 5 years immediately. which they didn't have. But I think that you got to lay the groundwork ahead of time. And I think that's really where we're at right now for allowing investors to access private asset classes.
If we could time travel back a few weeks and stand in the middle of, say, April the 3rd or 4th or something like that and shine a flashlight around at the volatility, just speak to illiquid assets in a moment like that where markets are, I mean, whipsaw was the term that was used the most.
I think that right now, a lot of investors have, the liquidity equation is set out for them. They're investing in publicly traded equities and bonds. So that's taken care of. But the risk profile isn't. And it's something that we cannot joke around about. We have to take it really seriously. What is the risk profile? How much risk will you endure? How much market movement will you endure? And I think the same will go is we're going to start to have more serious conversations about liquidity. Like, what is your cash flow scenario? What does it look like in the next 1 to 3 years? What does it look like in the next 10 to 15 years? And I think that those real conversations need to take place in order to determine who these vehicles are a candidate for and who's best suited to access these longer-lived assets that are less liquid.
Okay, that's great.
So just to tune back to the April moment, thinking about that time, while one side of the portfolio might be off, thinking about U.S. markets, let's say 14 to 18% at a point in time, depending on which day you looked at your statement, there's no panic sell. There's no, I'm going to rebalance. Like, these are longer term assets. And for example, a lot of these vehicles you subscribe to on a monthly basis, you might redeem on a quarterly basis, for example. So you don't have immediate access to your capital either.
Right. And so it just takes that, could I hit the sell button right out of the equation in that particular,
at 2:30 on a Wednesday?
At 2:30?
No.
That's right, it's not going to happen. Okay, here's a great question. So is this fund available in both trust and a corporate class version? Yeah, how do you get in?
Yeah, absolutely. So this fund would not be available in corporate class.
Okay. So we've heard a lot, and actually when we spoke to you last on Fidelity Connect, we talked a fair amount about crypto, at least some of the discussions there. In the intro, we were talking about that being in the alternative universe. Obviously, it's what's being offered. It's not brand new. It's been around for a little while. It is kind of a new landscape, though, since the Trump administration came in with a very pro-crypto stance and regulatory ability, essentially. Bring us up to date on what's interesting about crypto right now.
Okay, so we're going to go from talking about something that annualizes 8 to 10% to something that swings at times daily,
well,
8 to 10%.
They're called alts.
Yeah. So I think that with respect to the digital asset space, we'll speak mostly through the lens of Bitcoin, but there are a lot of really exciting developments ongoing at present that were happening before the current administration came into place, as well as that have really ramped up. And I think that people think of regulation as a bad word, but regulation is necessary for spaces to grow and things to carve forth in an above board manner. And I think what you're seeing is a lot of people in a lot of really important positions that have made it quite clear that they're willing to play ball and properly regulate what is a growing space that has been kind of pushed to the side for some time. Like, there's a lot of momentum, and this is not a small space. Like, if we look at any point in time, it was different on January, it was different sort of at the end of Q1 than it is today. This is several $1 trillion in size, this space, and there's a lot of momentum, there's a lot of innovation, a lot of development going on.
Okay, and therefore, I mean, for instance, in the all-in-ones, there's a slice that is included in there. I mean, any thoughts on sort of the allocation story at this stage?
I would say that for those that are looking to gain exposure to digital assets, that sticking with one of the main conventional digital assets, whether it be Bitcoin or Ethereum, would be a great way to go. I think that as you move down the spectrum, risk and validity to these names and staying power, like you see a lot of these coins that kind of pop up and they're gone 6 months later. We need to be really careful as you kind of get down that spectrum. But I think that if you look at sort of the validity and staying power to the top 4 digital assets, whether that be Bitcoin, Ethereum, Solana, XRP, I think that each of them bring forth, whether it's their ease to transact, their security and safety, each of them bring forth unique characteristics that have kind of brought them to where they are today. Could someone else come online and challenge that top 4 spot? I think it's a reality that could be a thing. But I think with respect to Bitcoin in conventional portfolios, the all-in-ones are a great way for the everyday consumer or the everyday investor to have a 1 to 3% allocation without necessarily trading on a wallet on their own, tracking their own cost basis, worrying about losing their keys and maybe not recovering their money that they've uploaded to a digital wallet. So you can also hold it in registered accounts, TFSA, RRSP. We track your, whether you buy FBTC individually or you hold it through the all-in-ones, we track your cost basis. It can be in registered accounts. I think there's a ton of benefit or validity to accessing digital assets through conventional means in your usual accounts.
Fascinating. Okay, well, let's go back to real estate because that's sort of our discussion for today. The price discovery process of various parts of the real estate market does seem to be in flux. We look to the US, they're having discussions of not a lot of mobility is allowed right now because people can't buy and sell. They're sort of in that, a bit stuck in the price discovery moment.
30-year mortgages.
Aren't moving, 30-year mortgages,
Yeah.
They're stuck. How different is it here? We have our own problems in the real estate side of things. How is price discovery going? And I guess on that, how much can you just let it be that the fund takes care of that? Because you don't have to worry about that.
Yeah, I would say that like the environment that the fund operates in and the everyday consumer market that we're looking at, they are different things. They're very much correlated to one another, be it the Canadian housing is very much correlated to the success and where prices transact on like a multifamily asset standpoint.
Sure.
That
and
said,
to the labor market and the economy. And
yeah, we can all look around our neighborhoods. We can all go on the various different realtor apps and assess that homes are selling for less than they did in late 21 and into 22. Yep. We've all seen the stats about record number of mortgages rolling over, whether that's fixed or variable, through 25 and 26. I mean, 25's here. We're right in the middle of it.
That's right.
And I think that you're starting to see like the rug pull on home equity lines of credit, value that was once said to be there. Banks are protecting themselves. They're pulling that back. So there is a lot to unfold in the Canadian landscape with respect to the housing environment. And I don't want to neglect that the level in which this fund is operating on is very much connected to the Canadian housing environment. But at the end of the day, these are properties that are, for the most part, close to fully tenanted. Right. They are rented to quality tenants. They are making money. Where the house transacts for down the street, there is somewhat of a disconnect to operating a profitable in-place rental apartment, if you would, and sort of the turmoil that is unfolding in the short to midterm at present. But there's certainly a lot going on with respect to the rate environment. Yes. I think there were a few Canadians that got maybe lucky to clip a 5-year rate in the high 3s, right, maybe 30, 60 days ago. We're seemingly back up into the 4 environment. And where that goes is anyone's best guess at this point in time.
How does the Canadian real estate market look versus the rest of the world, or versus like key markets? We mentioned the US. Okay. But if you're an investor either outside of Canada or you look to the global market to see which real estate market might be interesting to enter, how do we stack up?
The short answer is we're expensive. Right. We came out unscathed from 2008. And I think that if you look at the US, for example, a lot of people remember that for a long time. In Canada, it was kind of back to the races, right? Yeah. So
we didn't do the deleveraging.
If you look at various different stats, like home prices as a percentage of disposable income being one of them, it's like we're high. There's no debate there. So I would say that we are expensive, but again, we can remain expensive in perpetuity. That could be a characteristic of our housing market. There's no saying that needs to go away or mean revert to another area that's completely far out from where we are here.
Okay, so let's have you kind of wrap this up a little bit for us. Take us through just a kind of a final message for those that may very well want to look at alts broadly, but specifically this real estate option.
Yeah, absolutely. So Fidelity Alternative Real Estate Trust, I think that it's a new vehicle that we stood up on March 17th of this year. We've accessed the expertise of Brookfield, and we're thrilled with sort of the work and due diligence that they've put forth. It owns 6 properties at present. Who is this for? It's for someone on the upper end of the market that's looking to maybe divest, sale of business, and or maybe they sold rental properties in specific, but they want to maintain exposure to the asset class. It could be from someone that maybe doesn't have that exposure to the asset class that we touched on. Right. It could be for your average everyday investor that wants to hold maybe 5 to 10% exposure to private real estate as an asset class from a portfolio construction standpoint. There was a UBS family office report that just came out. On a global basis, they'd assess that 11% of allocations on average are allocated to private real estate. So there's there's a rough number that we can go off of that say that from a portfolio construction standpoint, private real estate has a real viable position in one's portfolio. So
it's really exciting to hear about this.
Yeah. So I think that this is a space that more Canadians are going to get access to. And we're really happy to be a legitimate player in the private asset space, offering Canadians exposure to private real estate.
Great to see you, Brendan. Thank you so much for explaining that and sort of taking us through this amazing offering and kind of how you get access to it. Brendan Sims, thanks for joining us today.
Thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.